Okay, so we have used the corporate value model. Now we're going to shift over to the model that Wall Street relies on primarily to value stocks, how Wall Street comes up with a fair price or a target price for a stock. So as you can see, developing a discounted cash flow analysis to value a stock is very time consuming and requires a high level of confidence. You've got to know what you're doing. There's a lot involved. There's a quicker and more intuitive approach to price a stock, and we're going to use pricing information provided by the securities markets to help value stocks. So we're going to use the securities markets. Specifically, I'm referring to multiples, putting together multiples. Remember that a multiple involves putting the market price of one share of the stock of a company in the numerator, and then you put the company fundamentals like sales, EBITDA, earnings per share, and free cash flow on a per share basis in the denominator. So we're creating a multiple, stock price in the numerator, fundamental per share in the denominator. Okay? A multiple reveals what investors are paying for fundamentals, valuation. That's what a multiple is, it's valuation. It makes sense to look at several multiples for a stock to try to get a high degree of confidence for our valuation or our price. Just looking at the clips we're going to go through, slide 49. Okay? Multiples that are relatively stable, multiples that don't bounce around a lot, typically generate values that are more reliable than multiples that have wide dispersions. Okay, so we will compute several multiples and we'll favor those multiples that tend to be more stable. You're going to see what I'm talking about. All right, so let's look at Apple's fundamentals. Okay, so here are sales, historical sales, EBITDA, net income, free cash flow, and book value. And then here are the number of shares. So now let's convert these fundamentals from total numbers into per share numbers. We will divide each of these numbers by the number of shares. And here we go. So here are the fundamentals on a per share basis. Okay? So these numbers go in the numerator, in the denominator. And what numbers go in the numerator? Well, we'll put the high stock price. So we're going to divide the high stock price for each year. This is the peak that the stock reached in each year. And we'll divide this number by this, by this, by this, by this, and by this. And we'll divide this number by this, and we'll divide this number by this, and this number by this. You see what I'm doing here? You catch my drift? And then we will also use the low stock price for the year, and we will find the low multiples. So we're going to find the high multiples and the low multiples. So we'll divide this number by each of these numbers, and this number by each of these numbers. So we'll find high multiples and low multiples. So we're going to find price to sales, price to EBITDA, price to earnings per share, price to free cash flow per share, and price to book value per share for each year, the high multiple and the low multiple. Okay? All right. So here are Apple's historic multiples. Okay? These are the multiples that the stock has generated in the past. High price, low price. So this is price to sales, price to EBITDA, price to earnings, and price to free cash flow, and lastly, price to book value. Okay? So we can see how these multiples have bounced around. Boy, this price to EBITDA has been cut in half. Okay? It's really gone down a lot. Same thing with earnings per share. PE has gone down. Free cash flow has gone down. All the multiples have gone down. Why? Because Apple's growth rate has gone down. Okay? The growth rate is slowing. And maybe because interest rates in the marketplace could be going up, which could cause multiples for all stocks to go down. So there are always at least two explanations, one company specific or two sources of influence on multiples. One is what's happening with the company. Are their growth rates slowing or accelerating? And two, what's happening with interest rates in the economy. or what's happening with pessimism, sentiment, pessimism or optimism on the part of investors. All right, so here is a history of multiples. Now let's go through and let's try to pick multiples. Let's pick the best high and the best low, and then we're going to pick a likely. How do we do it? How do we pick our multiples? Well, we're going to overweight the last couple of years. Why? Because they are more relevant. They're more recent, so they're more relevant. I feel better about using these numbers here than I do about using these numbers here. Something's changed, and I don't feel real comfortable relying on these high numbers to project into the future. So overweight the last few years. Now we're going to eliminate the outliers. Okay, what's an outlier? An outlier is a number that clearly does not belong. Okay, and so the highest high looks a little too high for me. This number may be a little too low. Down here, this number looks pretty low. This number looks pretty high. But what we're really looking for are things that just stand out that obviously do not belong. Do not belong. All right, once we eliminate the outliers, we'll pick a likely multiple for each, okay? And we'll consider the lowest high and the highest low, and we'll go somewhere in between. So somewhere in between, the lowest high is 15.5, and the highest low, we're going to eliminate this outlier, is 12.5. Somewhere between 12.5 and 15.5 is our likely multiple. All right, so let's go ahead and let's pick the best high and best low for each multiple. Price to sales, price to EBITDA, price to earnings, price to free cash flow, and price to book value. So let's start. So we're going to choose and we're just pretty much eyeballing it, folks. That's how it works. So we're going to choose 5 as our high price to sales. Then we're going to choose 2 as our low price to sales. And our likely price to sales is 3.75. So what does this mean? This means when we place a value on our estimates, we want to see where the stock looks like a good buy, it looks cheap, inexpensive, it's going to be somewhere around 2. And where does it look really pricey or expensive? Somewhere around 5. And what we think is a reasonable value, 3.75 times sales. So we're going to buy the stock when it's closer to this number. We'll start getting itchy to sell when it's this number, and by the time it gets here, we're out. We're out. Too expensive. All right, so we're going to go through this process with each of these multiples. Okay, 13 is our high, 6.5 is our low, 10 is our likely price. When the stock is trading somewhere close to 6.5 times, we're all over it. We're buying. When it's trading at around 10 times, we're starting to sell some. By the time it hits 13 times, we're out. Same thing with our PE, high, low, and likely. And with our price to free cash flow, high, low, and likely. And then with our price to book, high, low, and likely. Okay? So now we're just going to take these numbers here and put them on a table on the next slide. Here we go. So we're going to use these numbers. Okay? High, low, and likely. Projected price, high, low, and likely. So we're going to come up with 3 prices. Okay? Using sales per share. Here's our projected sales per share for 2013. Here are the multiples for 2013, price to sales. So we're going to multiply this times this, this times this, and this times this. And we're going to come up with 3 prices. Okay? So what is this telling us? When the stock is in this vicinity, it's cheap. In this vicinity, it's fairly valued. In this vicinity, it is overpriced. We buy it somewhere in here, and we start selling it here, and we're shorting it here. That's what I'm telling you. All right, we're going to do the same thing for EBITDA. There's our forecast, there's our multiples, there are our prices. Okay, earnings per share. Notice how close those prices are. Free cash flow. Okay, not too far off. All right, and our book value. Using book value. So here are all the multiples. Now please note that once you get about 2/3 of the way through the year, somewhere in the August to September area, okay, guess what? People start shifting their focus to the next fiscal year. Okay, so we'll look at 2014 forecasts. So we're going to multiply these forecast fundamentals by the forecast multiples, and we'll come up with these prices. This is for 2014. Okay? All right. Now let's grab these numbers and put them on another table. Okay? We'll eliminate the outliers, we'll be conservative. Okay? So these are the various prices that we get using the different multiples for 2013. Okay? So, high price of $1,100, low price of $550, and a fair price of $832. Okay? So once again, if the stock is trading below 600, we're interested. If a stock is trading above 800, we get a little nervous, and once it crosses the $1,000 mark, we're going to be selling like crazy or shorting. Okay? These are the 2014 numbers. Once we work our way through 2013, we start getting toward 2014. These are the numbers we're going to look at. Okay? Where do we buy the stock in, halfway through 2013? If the stock's trading around 700, between 700 and 800, we buy it. If it's trading above 1100, we start to sell. 1450, we're shorting. Okay? What are we looking for? Well, we're going to have to do these valuations for all the stocks we're interested in. That's why there's so much work to do when you're trying to be a portfolio manager and a securities analyst. Lots of stocks to value. And we are looking to buy stocks that have a favorable upside to downside ratio. In other words, where's the current price? How much upside do we have? And how much downside do we have? And if we have more upside than downside, and typically we like to have a 2-to-1 upside to downside ratio. So if our downside risk is 25%, we like our upside potential to be 50%. Okay? So we look at a favorable upside. For Apple, here was their likely price. The upside is 67% or 68%. The downside is $550. We think the downside is $550. The stock's already trading below the downside. So what this tells me is there's very little downside risk in Apple, okay, unless something very surprising happens, and there's 67% upside risk. That is a good upside-downside ratio. Okay? All right. Once we do this historic valuation, all we've done is trend analysis for Apple. But once we do our trend analysis, we then have to do our peer analysis. We then look at the multiples for stocks of companies that are in the same industry. Okay? Research what the multiples are for competitors. Peer analysis. Boy, doesn't this make you tired? It makes me tired. That's why I don't do it anymore for a living. All right. Be sure when we pick a peer that they're in similar businesses. You check the growth rate of their fundamentals. If one company is growing their fundamentals a lot faster than another company, you can't use those multiples. Okay? Check out the profit margins. If one company is much more profitable or much less profitable, you can't use their multiples. Okay? Check out the leverage. If one company has a lot more leverage than another company, can't use their multiples. You can use the multiples, but you have to adjust for all of these variables. All right? Check the size of the company. If one company is much larger than another company, that probably will affect their growth rate. Okay? And then lastly, check on the volatility of their stock prices. If one company has a much more volatile stock, guess what? Their multiples are probably going to be lower. Okay? Lastly, keep an eye on interest rates. Okay? When you're looking at peer analysis and trend analysis, if interest rates are going up, then your multiples will go down unless your growth rates accelerate. Okay? So watch interest rates very, very closely. Okay, so we are finished with this section. We'll go on to the next clip. Until then, peace out. Shalom.